If you go on YouTube, most traders post big profits and a flashy lifestyle, or you just want to make your first couple of dollars trading. That's why inside of this video, I'm going to be breaking down the exact strategy that I use to be able to make my first 1,000. So first, we want to start off with identifying market structure, which is the foundation of the strategy and the foundation of the markets. Now, the market is either moving one of three ways. We are either inside of an uptrend where we are making higher highs and also higher lows, a downtrend where we are making lower highs and also lower lows, or we are inside of consolidation where we aren't really moving that much. The highs and lows are basically the same. These are the three ways that the market moves each and every single day, both on the higher time frame and the lower time frames. For this specific strategy, we want to focus mainly on when we are making higher highs and higher lows and lower highs and lower lows. We want to focus primarily on the trend because that is how we're going to get the best risk to reward. So after we have identified market structure, we then want to identify liquidity next on the lower time frames. So we know that the market moves inside of downtrends, uptrends, and then sideways markets. On the lower time frames, markets normally move off of levels of liquidity. So if you have been trading for a while, you've probably noticed that you'll be inside of a trade and the market might just dip lower, stop you out at your stop loss, or not even there, close to your stop loss, and you get triggered out of the trade, and then the market continues to go inside of the direction that you thought it would go inside the first place. That is a liquidity sweep. The market needed that liquidity in order to move in the direction that it wanted to go inside of the first place. So knowing where liquidity is resting at is a very important piece of this strategy and helps us in order to be on the right side of the market. So normally where liquidity is resting at, one of the most important areas is session highs and also lows. So what do I mean by session highs and lows? There are three primary sessions that we trade inside of the markets. We have New York, London, and also Asian session. This strategy primarily I focus on traders who trade during and also London. So if we are trading during N1, what I mean by session highs and lows is marking off the high and low of the previous session, which is London. So we want to mark off those two areas, the high and low, because traders normally during these sessions put their stop losses above the highs and also the lows of that specific session. The same thing if we are trading London session. We want to mark off the high and low of the previous session, which is Asia, because traders normally put their stop losses above the highs and the lows. So another thing when it comes to liquidity is that the timing. So most traders, when they are trading liquidity, they do not pay attention to time. They trade any time of day and end up getting stopped out. We want to pay attention to the time. We want to be trading primarily during the first 1 to 3 hours of the session opening. You will see that during this time, a lot of the times we will see that the session will open, such as New York session will open. We will see London over here, where London's high was at. We will see a sweep. Actually, let me draw a better example for you guys. So this right here is London session right here. And then let me change it to New York in black. So this black line is now New York. During New York, we will see a sweep above here, which is London's high, during the first 1 to 3 hours of that session opening. And right here, once we get the sweep above London high, of course, we will be looking for the market to then go lower. Now, after we have identified market structure, We also know our areas of liquidity. The next thing we want to pay attention to is where is the market actually into. We know that we've just taken out of area of liquidity, but we also want to see the market tap into either a fair value gap or a supply or demand zone on the higher time frame. Why is this important? Because this identifies the supply and demand of the overall market. If we get a tap into an FVG and it respects 50% or more of that FVG, we can expect that the market is probably going to continue in the opposite direction. Because if we get that respect of these levels along with the liquidity sweep, we can kind of think about it as band, where price will naturally gravitate to where it was already going to. So to draw this out for you guys, let's say that we have a fair value gap, which is right here. This is the large fair value gap. This is price action. This is London right here. And then let me draw New York in red. So during New York, we get a sweep of this London high, which is this black line. This was the high of London right here. This is the fair value gap right here. It taps then into this bigger FVG. We respect 50% of this FVG, and we're just waiting for price to then go higher and retrace so that you hit our final risk to reward. Once I get on the charts, you guys are going to see a better explanation and a better way to see all of this together. Now, once we have our FVG or supplier demand zone marked off, all we need is a simple entry criteria confirmation. All that we're looking for is a bullish or bearish engulfing after we tap into that FVG or supplier demand zone. We are mainly just looking for the market to react with a bullish or bearish engulfing. So let's say that we're overall bullish on the market and we get a sweep of the lows of London. We then, inside of New York, want to see this bullish engulfing, indicating that the market is probably going to go inside of the higher direction. Now that we have gone over this on the charts or on the whiteboard, I'm going to show you guys an example of this happening during the live market, and then so you guys can have this model down and follow it and do it on your own. So let's first come into the markets and mark off our market structure. As we can see on Go during this time, let me go to GC. As we can see on Go during this time, we are obviously making these higher highs and also higher lows. I don't even have to draw it out for you guys. You guys probably already see it, where here we're making higher highs, higher lows, higher highs, higher lows. And so after that, we go then and mark off our areas of liquidity. For identifying where liquidity is resting at, I'm going to go to my indicator and type in sessions so that we can see each session. So we can obviously mark off the high and low of each session. So mainly here, I'm focusing on New York. So we can see that during London, we have the high right here and the low of London right here. So all I'm waiting for during New York is a sweep of this low of London, which is right here. That brings us into our last step, which is a respect of a higher time frame fair value gap or supply or demand zone. So for this, I'm going to go to our higher time frame, which is our 1 hour or 4 hour zone. Here we can see that we have a tap into this higher time frame 1 hour fair value gap. Now we filled in about 50% of this fair value gap, and like we said before, we swept all of this liquidity as well. Now when the market does this, I'm looking at it as sort of like a rubber band. We are already bullish on where we sweeping. The only reason why we want to sweep is so that we can tap into these buyers so that we can push back into the mean. If you guys know statistics and standard deviations and all of that, the market always has to revert back to a mean, just like in statistics or population or sample sizes. Each day, the market is kind of like that, where it makes a certain percentage gain, but overall, it has to revert back to what the average is in general. So when we are kind of like making these extreme liquidity sweeps, we have to time reverse back to the mean. That brings us to our last step, which is our entry criteria. Like I said, since we are bullish, we are mainly just going to be looking for a bullish engulfing candlestick inside of the overall direction that we want to see the market go in. So here we get that bullish engulfing candlestick that we're looking for. The next thing is just waiting for the trade to play out, going for our 1-for-1, 1-for-2, 1-for-3 risk to reward, and then letting the trade play out. And that's it. This model is the model I use month over month over month to be able to have consistent. I don't even trade that much every single month. I wait for my specific model, which is this one, to show up, take a trade every single month, and it works. All right. So I hope you guys enjoyed this small, short YouTube video going over my stupidly simple A+ strategy that I use month over month to be able to make my first $1,000 trading. Make sure to comment down below if you guys have questions, and I will make sure to get back to each and every single one of them.